Welcome to Finbot Insights. We're not here to speculate on Bitcoin's price. We're here to declare the end of an era. The central argument we are presenting today is that by 2026, the old four-year cycle of boom and bust is over, and a new, more mature phase for the asset has decisively begun. This quote really cuts to the heart of the matter. The game has fundamentally changed. We've moved far beyond the point of simple price speculation. Now, the critical task is to identify exactly where Bitcoin sits on its adoption S-curve, because the rules that governed its first decade are, for all intents and purposes, obsolete. Let's begin with Bitcoin's institutional graduation, a structural paradigm shift. What this means is that Bitcoin has transitioned from the chaotic playground of early retail adoption directly into the boardroom. It is no longer a niche internet curiosity. It is now a structural component of the global financial system. The numbers that follow will demonstrate this shift unequivocally. $1.79 trillion. This is Bitcoin's market capitalization as of January 2026. Let's be perfectly clear. This valuation is not the product of fleeting retail euphoria. It is the result of a deliberate, structural reallocation of capital from traditional assets into Bitcoin by the world's largest financial institutions. This represents a permanent change in how institutional capital perceives and interacts with this asset. The contrast between the past and the present is stark, and it tells the entire story. The past was defined by retail-driven speculation, a chaotic roller coaster of emotion. The present, our reality in 2026, is defined by patient, strategic, institutional capital. This isn't hot money chasing short-term gains. This is calculated long-term allocation. The very nature of the capital securing the network has undergone a permanent and irreversible change. So, what's the mechanism behind this shift? It's what we call the Wall Street flywheel. This is the primary engine driving this new era, unlocking global capital through regulated financial vehicles. Essentially, Wall Street has constructed a superhighway for institutional money to flow directly into Bitcoin, and that highway is now open for business. $137 billion. That is the total assets under management in spot Bitcoin ETFs. To be absolutely clear, these products are not simply shuffling existing Bitcoin between wallets. They have created a persistent, significant, and largely one-way source of net new demand, relentlessly absorbing supply from the open market. Now consider who is managing this capital. The world's largest asset managers, names like BlackRock and Fidelity, are the primary custodians of the asset for millions of investors. BlackRock alone commands nearly $47 billion in its IBIT product. These are not fringe players. These are the very pillars of global finance, and they now serve as the primary gateway to Bitcoin. This integration extends into the most significant pool of long-term capital there is, the $9.3 trillion retirement market. We now see major wirehouses and even formerly resistant firms like Vanguard offering Bitcoin exposure in 401ks. This introduces long-term systematic capital that is programmed to rebalance into weakness, effectively creating a structural price floor and absorbing volatility. Now let's look at the escalation of balance sheet adoption, moving from corporate to sovereign treasuries. The adoption of Bitcoin as a treasury reserve asset did not stop with pioneering corporations. It is now scaled up to the level of nation-states themselves. At present, over 160 public companies hold Bitcoin on their balance sheets. Companies like Strategy Incorporated have pursued an aggressive accumulation strategy, viewing the asset as a superior alternative to cash in an inflationary environment. This is not a trend. It is a calculated response to macroeconomic realities. Corporate adoption was the necessary precedent. It proved the thesis. But the new frontier, the true paradigm shift, is sovereign adoption. When nation-states begin to treat Bitcoin as a reserve asset, its global risk profile is fundamentally repriced. And this is no longer a theoretical exercise. The establishment of a U.S. strategic Bitcoin reserve is a watershed moment, serving as a hedge against its own sovereign debt. But the trend is global, with varied motivations. El Salvador's pursuit of financial independence, Bhutan's sovereign wealth generation through mining, and the UAE's diversification of its sovereign wealth fund. The specific reasons may differ, but the direction of travel is the same. The story does not end with ownership, however. Perhaps the most compelling argument for Bitcoin's future is the recent explosion in its technological utility. It is finally maturing beyond the digital gold narrative to become a programmable financial layer. The question has always been, is Bitcoin just a store of value? For a long time, the criticism that Bitcoin lacked utility beyond this function was, frankly, valid. However, recent technological advancements have rendered that critique entirely obsolete. This new functionality is being built out on a thriving Layer 2 ecosystem. These are protocols that leverage Bitcoin's base layer security to enable more complex applications. Projects like Merlin Chain and Hami are bringing billions in total value locked for DeFi applications. Stacks is enabling sophisticated smart contracts, and the Lightning Network facilitates instant micropayments. This ecosystem is transforming Bitcoin into a programmable base layer for a new global financial architecture. So we arrive at the new market reality, where the 4-year cycle is in a state of decay. The structural changes we have discussed in both ownership and utility have irrevocably altered the market's behavior. The old cyclical patterns no longer apply. The consequence of this is that the 4-year cycle has been relegated to history. The predictable boom and bust patterns, once dictated by the halving schedule, are now being smoothed by the persistent inflow of institutional liquidity. The old rhythm of the market has been broken. The data provides clear evidence of this change. In past cycles, Bitcoin's realized volatility often reached between 80 and 100%. In the current cycle, that volatility has been compressed to a range of 20 to 30%. This dramatic reduction signals a structurally more mature market, one that behaves more like a G7 currency than a speculative tech stock. From a store of value perspective, it is important to note that Bitcoin has still only captured a fraction of its total addressable market. At $1.79 trillion, it represents just 5.5% of the value stored in gold. This indicates that even from this more mature foundation, significant growth potential remains. This brings us to our final question. The institutional era is defined by implementation. What will the next decade of global finance, built on this foundation, look like? The era of expectation is over. The era of implementation has now begun. Before we conclude, it is imperative to state that nothing in this presentation constitutes financial advice. This analysis is for informational purposes only. You should not trust us or any other social media influencer with your financial decisions. Always conduct your own extensive research. If you found this analysis valuable, we ask that you click like and subscribe to FinBot Insights for more data-driven research. Your engagement helps us continue to produce high-signal content in what is often a very low-signal world.